Hey YouTube, so I'm making another video about my stocks. So basically, I haven't made a video in I think a few weeks now, and I'll just sort of explain what's happened. I sold. I can't remember how, because it's been so long, but I exited out of Shopify and CLS and NXE and some other stocks that I was holding. But I still have some call options because I thought the price was gonna keep going up, but it's not, so I'm not sure. The NXE is almost in the money. It's almost in the money. So I don't know what's gonna happen there. CLS, I think I bought it at the highest, so right now it's been going down. Shopify's been going down. So mainly what I'm holding now is IVN, which is well, I don't really know what to say about it. It's like a mining company, I think. But anyways, I bought it because it has a high call to stock ratio, which is so basically the price of deep in the money call option divided by the price of the stock. It's more than 50%, and then it has like a decent profit margin. And so I'll explain my strategy. Is basically like this. So I buy the stock, I sell deep in the money call option. So for IVN, I sold the $8 strike price call option at for $4.40. So that was back when the stock was $11.11 per share. So then the delta is at 0.88, so which means that if the stock was to go down in price, the call option would also go down in price with an 88% correlation. So then initially I would have an upper bound and a lower bound. So as long as the stock price stayed within the range between $8 and $12.43, then I don't have to do then I make money. If it falls below $8 or it goes above $12.43, then what I can do is something called a rollout. I can roll the option. So the meaning of that is so for IVN, so the call option, the stock price rose above $12.43. So right now it's at $12.55. So I'm trying to roll up, which means that, so initially I sold 20 calls for IVN. So then I bought 4 of them back at $8 strike and sold 4 at $9 strike. So I rolled it up by $1. So then the new range is between $9 and $13.70. So obviously it's between $9 and $13.81. So then that means that as long as it doesn't fall below $9 or go above $13.81, then I get the maximum gain. But obviously, if it goes above that, then my profit above that is limited. So so I only have 4 of these. So then I'm gonna have to buy the other 16 back to do another roll up, to roll up these the other 16 from $8 strike to $9 strike at least. I don't know if the stock price is gonna go up above 1381. Obviously, if it does, then I have to roll this up even more. So basically, one thing that I realized is that I can roll the option. So if the original range for the call option, if the price of the stock goes out of the original range of the covered call, I can roll the option up or down. So this is an example of the rolling up. And then I also bought FM. So FM, I can use an example of rolling down. So FM has been really bad. So I bought it at $13.94. Now it's at $10.39. So obviously, originally I sold the covered call at 10, and right now it's at 10. So I already did a roll down. I rolled down from $10 strike to $8 strike. So I don't remember what the original range was, but the current range is between let's see, what is it, between $8 and $12.43. So if it goes below $8, then I have to roll down more. If it goes above $12.43, then I have to roll up. And obviously, when you roll up an option, you lose money. At least initially, you have to put in more. It's a debit. It's a net debit. It's a net debit. So basically, for every dollar that I roll up, for deep in the money, it's usually about for every dollar that I roll up deep in the money, I have to pay 70 cents. So that means that I only make 30 cents. So it's like if I roll up, I don't make the full dollar. I only make 30 cents on every dollar. But it's still better than if I don't roll up, because if I don't roll up, then because the delta is almost 90%, so then the profit is only 10%. So it's still better to roll up. Rolling down is the exact opposite. So for every dollar that I roll down, assuming the volatility is about the same. If the volatility is the same, then if I roll down, for every dollar that I roll down, I make 70 cents profit. So it's 70% profit. So if I roll down $2, then the call option, I buy it back for $140 more than I sold it for. So when I roll down, I make money, and when I roll up, when I roll down, it's a net credit. When I roll down, it's a net. When I roll up, it's a net debit. When I roll down, it's a net credit. Anyways, then the other one is WEED. So I also ruled this up because originally I sold at this at the $0.5 strike. So then the range was like the upper bound on the range was 88 cents. So it's already above 88 cents. So so I bought that back, and then I sold another one for $1. The thing with this though is that I still lost money when I bought it. Well, I guess that's normal. So if stock price goes up, then you lose money if you roll up. But it's still good. It's still good. So like overall, you make money in the stock plus the call option combination. But just doing the roll up, you lose money on the call option. On the call option transaction. But if you were to sell the stock, then overall you should make money as long as the call option is at the same volatility or lower as when you originally sold it for. Because obviously higher volatility means higher call option price. So then the other one I have is CCO, which hasn't really done anything. It's just been going sideways. Goes up maybe $1 and then goes down $1, goes up $1, get down $1. It hasn't done anything significant since I bought it. And the call option's done roughly the same thing. I don't know why the call option was worth slightly more than it was when I sold it. I think just like a tiny increase in the volatility. That's about it. And then finally I have BTE. So for this, it also went down, even though the company itself is doing well. Like the earnings report is very good, but I don't know why the stock price is going down. So stock price that went down like 79 cents since I bought it, but I haven't ruled the option up or down because right now the range is between $3 and $5.49. So it's well within. So it's still within the range because it's a pretty big range. It has to fall down below $3 before I have to roll down, or it has to get close to $3 before I have a reason to rule it down. So anyways, the main reason I chose these stocks is because of the price per share and because of the call to stock ratio. So the call to stock ratio, I can explain it like this. So for it's basically the inverse of the leverage. So the call to stock, if you do the inverse, it's the leverage. So right now I have 171% in Canadian stocks, which means that I have a 1.71 times leverage with my investment capital, and I have 15.3% in cash. And you can kind of ignore like the unrealized gain loss and whatever, because that depends on the price of the call options on a specific day. It significantly affects the value. So the better way to look at it is just to look at the market value versus the book value for my actual stocks. So So the book value is 72,000, market value is 72,000. So so my stocks are doing fine. It's just see, so BT has gone down and WEED has gone up 28%. So that's gone down 15%. FM's gone down 25%, and IVN's gone down 12%. And CCO's just been, hasn't really done anything. And if you're wondering why I still am invested in CCO, first of all, if I were to exit the call, if I were to exit the covered call, I would lose some money. But the main reason is because CCO in the long term, at least in the 1 year and 5 year, it has like 60% or more annual return. So I'm holding it because I think that it's not going to go sideways forever. I think eventually it's going to go up a lot, because that's been the trend for the past few years. At least it's what should happen. So it's the largest share in my portfolio because it's very safe. I think it's the least risky of all the stocks that I own. IVN, it's it's going up a lot. BT is going down a lot. And WED, obviously a very, very risky stock. FM is also a very, very risky stock. So CCO is, so that's why main CCO is my biggest holding, is because it's very safe. But obviously it's not making me any money, but it should eventually. And then obviously I have some cash in order to buy back call options. Mostly, that's mostly what it's for. So I have to keep some cash in order, because if I don't have any cash, then I can't buy back my call options. So I usually leave at least 5,000 as cash. And then the call options is completely crazy, so I sort of ignore it because call options obviously very volatile. The main thing that I don't like about call options is the bid-ask spread is very wide. So for example, maybe the bid is $4 and then the ask is $6. So then the bid-ask spread, the spread is $2 for an option that is worth between $4 and $6. So the spread is like 33% to 50% of the price of the actual option. So that's why the market value for the options, the call options, just fluctuates wildly, because the bid-ask spread itself is crazy. So that's why usually I try not to buy or sell call options too much, because unless I can get a really good price, because usually the ask part of this, the ask price is a really bad deal, and then the bid price is a really good deal, depending on if you're buying or selling. And I try to do in the middle, but the problem is that if you do right in the middle, so bid plus ask divided by 2, if you do the average, most of the time the offer doesn't go through, like it's not successfully bought or sold. So that's it's a little bit so basically that means that if I want to buy, then I have to buy for the ask price if I want to buy it instantly. If I want to sell, I have to sell for the bid price, and because the spread is so big, then it's usually a very, very bad deal. So that's why I'm really careful about this. So that's why even though I want to roll IVN up, I want to roll all of my IVN options up, IVN calls up from 8 to 9. I haven't been able to do that because I try to put in for the average price, because then it's, you know, a fair deal. But then the transactions don't go through. It's like nobody wants to buy or sell at the middle, so it's just nobody wants to meet me in the middle. That's sort of the problem. So I sort of try every day to see if I can, but that's mainly the issue with trading options, is the bid-ask spread is really big. For stocks, the bid-ask spread is very small. You can usually it's like the bid-ask spread is usually the market price plus or minus 1 cent. So it's just there's no reason to put in a limit offer for stocks, but for options, if you don't put in a limit offer, if you do a market, then if you do a market offer, it's usually end up with a very bad deal, whether you're buying or selling. So just look at my performance, and it's gonna say like it's pretty bad because mostly I've been trying to get in a good position, and I think I made a few mistakes overall, but anyways, I don't think it's really a big deal, because I think if I hold it in the long term, I definitely will make money. So anyways, if it's mostly just the call options really skews the result. So it might be, you know, very, very positive or very, very negative, depending on what the call options are priced at for this particular day. So my total gain loss is down, and that is because I have to do the roll up. So I have to do the roll up, and then so for FM I did the roll down and I made some money, but whenever I do a roll up, it gives me a net loss, because a roll up is a net debit, so I have to pay money to roll up, and I only get that money back if I sell the stock. So that's basically it. And then before that, I'm not sure if overall I made money or lost money, because I think I did very badly, like because in the beginning I went long on a whole bunch of call options, and then most of them I either sold for a loss or it expired. So I think I lost a bunch of money there, and then as soon as I started doing covered calls, it was much safer. So I think overall, if I ignore the long positions on my calls, it should be break even. So one word of advice that I have is basically never ever Never buy call options, only sell them. Only do covered calls, never speculate on an option, only do covered calls is basically my advice. Because even if you think that you're gonna make money, unless you have some sort of guarantee, then more likely than not, you're gonna lose money. And so basically, covered calls, it gives a guarantee because you're guaranteed within the range from the lower bound to the upper bound. You're guaranteed that you make money, and then if it goes out of bounds, then you can adjust the boundaries so that you keep making money. So that's why I recommend covered calls. Not because it's the most profitable strategy, but because it has the lowest risk. So what I mean by that, and I don't mean regular covered calls either, I mean deep in the money covered calls, because the delta is high. So basically my goal is to minimize risk rather than maximizing reward. So that's why I prefer deep in the money. So the deeper in the money, so the higher the delta, then the more cushion I have if the stock falls in price. What I care about is losing as little money as possible if the stock falls in price. I don't care too much about what happens if the stock rises in price. I worry about that later. So then obviously I can roll up and then I can sort of lock in the profit, not 100% of the profit, maybe 30% of the profit, which is still okay, because I feel like in the stock market, if you're greedy, you will lose money. So the only way to make money is to not be greedy. So for example, maybe there's a lot of things that look like you'll make a lot of money overnight, or it looks like such a good deal, it's definitely going to make money, but there's the possibility. So there's the possibility that it's going to lose money, and then because of that, unless you can have some sort of a guarantee, you shouldn't do it. At least that's how I think about this, because for me, let me just see if I can explain exactly what I'm doing. So exactly what I'm doing. So maybe I'll use this. I think this is like anyways, well, this is kind of embarrassing, but obviously I didn't plan this ahead. I think there's an error. Something's broken for sure. Okay, so I'm gonna try it again. Or maybe I'll just end this video here, and then I'll explain in the description of the video, because I don't think this is gonna work. So anyways, that's the end of the video.